China's doing something big for its economy, and it's important for everyone. The country has been facing economic challenges, and this new plan is their bold move to address these issues head-on. They've announced a plan to help their economy, and it's worth a huge amount of money, $1.4 trillion. This isn't just a small boost, it's a massive injection of funds aimed at revitalizing various sectors. This is a really big deal, even for a country as big as China. The scale of this stimulus is unprecedented, and it shows just how serious the Chinese government is about turning things around. This news has surprised everyone around the world, and investors are trying to figure out what it means. Financial markets are reacting, and analysts are busy predicting the potential outcomes. One thing's for sure, this plan will affect lots of things, from the price of oil and metals to how well US stocks do. The ripple effects of this stimulus will be felt globally, influencing various industries and economies. This isn't just normal news, it's a big shift. The global economic landscape could change significantly as a result of China's actions. The whole world is watching as China tries to fix its slowing economy. Governments, businesses, and individuals are all paying close attention to see how this will unfold. Whether this plan works or not will be important for everyone in the coming years. The success or failure of this stimulus could set a precedent for how other countries handle their economic challenges in the future. Let's look closer at this plan and understand its implications. What does it mean for China's local governments, and how will it impact their operations and financial health? So, what's actually in this giant plan? The plan is vast and multifaceted, aiming to address several key issues. Most of the money is allocated to help local governments in China manage and reduce their substantial debts. These debts have grown significantly in recent years due to extensive spending on infrastructure projects like roads, bridges, and other public works. Additionally, the economic slowdown has exacerbated the financial strain on these local governments, making it harder for them to balance their budgets. The plan aims to provide relief by helping these local governments pay off their debts, thereby preventing more severe financial crises. The plan includes various strategies to offer this assistance, such as allowing local governments to borrow money through new financial instruments and mechanisms. Additionally, the central government is providing direct financial support to these local entities. It's a complex and ambitious plan, but the ultimate goal is to stabilize the financial system and restore confidence in China's economic management. However, it's important to note that this isn't just free money being handed out. The central government is imposing strict regulations and guidelines requiring local governments to adopt more prudent financial practices. They need to make smarter, more sustainable plans for the future to ensure long-term financial health and stability. This means careful planning, better management of resources, and a focus on sustainable development. By doing so, the plan hopes to create a more resilient and robust economic environment for China's local governments. Ultimately, the success of this plan will depend on the effective implementation and cooperation between the central and local governments. If executed well, it could pave the way for a more stable and prosperous future for China's local economies. Let's see how this news is affecting things in the Chinese markets. The recent economic developments have sparked a lot of interest and speculation. How are Chinese markets reacting? Investors and analysts are closely monitoring the situation, trying to gauge the long-term impacts. At first, the reaction in China's markets has been careful but positive. There's a sense of cautious optimism among traders and investors. Stock prices have gone up for businesses that will benefit directly from the plan, like companies that build roads and buildings. Infrastructure development is seen as a key driver of economic growth. The real estate market, which has been having a tough time, has also gotten a little better. This sector has been under pressure, but recent news has provided a much-needed boost. But some experts aren't so sure, saying the plan doesn't fix the deeper problems in China's economy. They argue that structural issues need to be addressed for sustainable growth. The Chinese yuan, their money, has also been going up and down since the news. Currency fluctuations are a common reaction to major economic announcements. It first went down against the US dollar, but then it got stronger, which might mean people think this plan is a good way to avoid a bigger economic problem. This volatility reflects the uncertainty and mixed sentiments in the market. The next few weeks and months will be important to see what happens because of this plan. Market participants will be watching closely to see if the initial optimism translates into sustained growth and stability. The unfolding developments will be crucial in shaping the future economic landscape of China. Across the ocean, US stocks are getting ready for changes. China's plan is affecting the US stock market too. Businesses that depend a lot on China, like technology, material and industrial companies, are watching closely. For example, companies like Apple, which makes a lot of its products in China, could see good and bad things. A stronger Chinese economy could mean people buy more Apple products. But the plan could also cause more problems between the US and China, leading to fights about trade. Similarly, companies that sell materials to China, like Freeport-McMoRan, which sells copper, could see China buy more if the plan leads to more building projects. But they also have to worry about changes in money value and trade problems. There's still a long way to go. China's economy still has problems. This plan is a big step, but it's important to remember China still has big economic problems. They're dealing with problems in their housing market, slow growth, and lots of young people without jobs. This plan, even though it's big, probably won't fix all of China's problems. The government will need to make more changes to fix these bigger issues. These changes will probably involve moving away from borrowing lots of money to grow the economy and finding a better way that focuses on people in China buying more things. This will take a long time and be complicated, and it might not even work. Dealing with uncertainty, what do investors need to know? So what does all this mean for investors? First, it shows that the world's economies are all connected. Things that happen in China can affect markets everywhere. Investors need to keep up with what's happening in China and change their investments if needed. Second, it's important to have different kinds of investments. Investing in different things and in different places can help protect you when things like this happen. Finally, remember that investing is like a long race, not a short one. Even if the market goes up and down quickly, it's important to think about the long term and focus on the important things. Looking for the good, finding opportunities in the challenges. Even though there are problems, China's big plan also has some good things for smart investors. Businesses that are ready to grow, like renewable energy, electric vehicles and healthcare, could do well because the government wants a stronger and healthier economy. Also, companies that are good at creating new things and focused on China are in a good spot to benefit from China's growth in the future. Like always, doing your research and having a good plan are important for dealing with these complicated situations. By staying informed and changing with the times, investors can be ready for anything, and maybe even make money from the opportunities that come up.